This is calm thinking for people who feel stuck in the system. This is quiet million. The dollar didn't change. The plumbing did. I held UST because the yield was too good to leave alone. A digital dollar, a stablecoin, paying almost 20% just to sit there. For a while, it felt like I'd found a door most people had walked right past. Then, in May of 2022, it came apart. UST slipped off its dollar peg and didn't climb back. And the further it slipped, the faster it fell. I wasn't checking reserves. The only question I had was, how do I get out right now? I swapped into USDT, not because I decided it was safer, but because it was the fastest way out of UST. When the thing is on fire, you don't audit the door, you take it. The question that actually mattered, what is behind this dollar? I didn't get to until it was already too late to ask. 3 years later, Congress tried to make that question impossible to skip. The Guiding and Establishing National Innovation for U.S. Stablecoins Act, the Genius Act, was signed into law on July 18, 2025. 7 months later, the effects are becoming visible in Treasury markets, international dollar flows, and the infrastructure that decides which currency the world actually uses. The mechanics of stablecoins now directly influence how much it costs the U.S. government to borrow money. And when borrowing costs change, everything downstream adjusts, slowly but definitely. Here's what actually changed on paper. Before the Genius Act, stablecoins existed in a regulatory gray zone. These are digital tokens designed to hold a one-to-one value with the dollar, unlike Bitcoin or Ethereum, which swing in price. Companies like Circle, which issues USDC, and Tether, which issues USDT, put these out, and people use them to move money between exchanges, send remittances, or just hold a digital dollar without the volatility. The problem was simple. No federal framework governed how issuers had to behave. Some backed their coins fully, some didn't. Disclosure practices varied wildly, and when something failed, there wasn't much recourse. The Genius Act put federal rules in place. Now, anyone issuing what's called a payment stablecoin in the United States has to back each one, dollar for dollar, with actual US dollars, short-term Treasury bills under 93 days, or other approved low-risk assets. They have to disclose what's backing it every month, submit to regular audits, get approved as a permitted issuer, comply with anti-money laundering and sanctions rules. And if the issuer ever fails, stablecoin holders get paid back first. The law rolls out over 18 months. By January of 2027, any stablecoin that isn't compliant can't operate in the US anymore. Here's the structural consequence. Every compliant stablecoin dollar now has to sit in US Treasuries or cash reserves. Issuers already hold over $200 billion in assets as of early 2026. Some projections show compliant issuers could be holding over $1 trillion in treasuries by 2030. For comparison, total outstanding treasury bills sit under $7 trillion. At that scale, stablecoin issuers become genuinely material holders of short-term U.S. government debt. So how does this change government borrowing? More buyers of treasuries lets the government borrow at lower rates, and scale is what determines the impact. Stablecoins solve a real access problem for people overseas who previously had friction getting access to dollar-denominated value. Anyone with an internet connection can now hold digital dollars backed by treasuries. That creates structural demand. Issuers have to hold treasuries. As stablecoin use expands, treasury demand expands right along with it. Lower borrowing costs mean lower interest expense for the government. And with the national debt past $36 trillion, even a small compression in yield changes the fiscal math meaningfully. There's a counter risk worth naming. If a stablecoin run forced rapid redemptions, issuers would need to sell treasuries fast. A large-scale liquidation could push yields higher, and the pressure isn't symmetric. A forced sale moves yields faster than steady buying ever brought them down. A contraction in $1 trillion market would not be a neutral event. The Genius Act reduces fraud and opacity risk through its reserve requirements and audits. It doesn't eliminate market-wide liquidity risk. It just reorganizes where that risk sits. What does this mean for everyday people? Stablecoins are increasingly becoming part of the actual payment infrastructure. They settle faster than traditional transfers and cost less to move across borders. Remittances, payroll experiments, global contractor payments. These are the early integration points. The Act gives you more transparency and gives stablecoin holders priority claims on reserves if something goes wrong. But stablecoins still aren't insured by the FDIC, and they don't carry a bank deposit guarantee. Issuers are also prohibited from paying interest, which keeps them from directly competing with bank deposits. They're built to function as payment rails, not as savings vehicles. For an everyday user, the real risks are still structural rather than regulatory. Losing custody of your funds, an operational failure somewhere in the system, or a temporary depegging during a period of market stress. The upside is real flexibility, faster settlement, broader access to dollars, and less friction moving money internationally. There's a bigger picture here too. Dollar-backed stablecoins extend dollarization without needing U.S. banks or Federal Reserve infrastructure at all. When people in countries with unstable currencies adopt dollar stablecoins, they increase global demand for dollar assets. And because those stablecoins are backed by treasuries, that demand directly supports U.S. debt markets. That strengthens dollar infrastructure inside digital finance before competing systems fully mature. Other countries are pursuing their own digital currency strategies. As financial infrastructure keeps digitizing, currency dominance starts depending more on integration into payment networks than on reserve holdings alone. If dollar stablecoins become the default settlement layer for digital commerce, U.S. monetary policy keeps transmitting globally, even when it's mediated by blockchain infrastructure underneath it. The risk is concentration. If stablecoin issuance consolidates into just a few large entities, those entities become systemically important nodes in global dollar liquidity. The Genius Act is still in phased rollout. Full rulemaking continues into 2026. But the structural effects are already forming. Banks are exploring their own issuance paths. Payment providers are integrating stablecoin rails directly. Treasury demand tied to digital dollar growth isn't theoretical anymore. The shift isn't explosive, it's cumulative. Stablecoin growth maps directly to Treasury demand. Treasury demand influences borrowing costs. Borrowing costs influence fiscal sustainability and the dollar's global position. This is a plumbing change, not a headline event. The Genius Act made stablecoins legible to regulators. Whether that legibility produces durable stability or just reveals fragilities that were already there is going to depend on how the system behaves under stress. The architecture is in place. Whether it strengthens the dollar or just reorganizes the fragility is something stress will decide, not me. But something did change for someone like me, someone who once swapped out of a burning dollar with no time to ask what was actually holding it up. The question I couldn't ask in the moment is now a question the law drags out into the open. Monthly disclosure, audits, reserves you can actually look at. The backing isn't something you find out about during the fire anymore. It's something you can check while everything's still calm. So that's the exit, if there's one to name here. Not a coin to buy, a question to ask early. Before you hold a digital dollar, ask what's actually behind it. For the first time, the answer is supposed to be sitting right there on the page. If you want to follow this as it develops, you can find it at quietmillion.com. No urgency, just the next observation when it's ready.